Hi, Channing Hamlet, Managing Director with Objective. We work with business owners often in helping them sell their company, and we do a lot of work with business owners in helping them think through being prepared. There are a number of factors, personal and business. We tend to focus on business factors and have expertise in that. In particular, when we look at a company, we think about the value drivers, areas which enhance the value of a company, and we think about saleability factors, areas which impact the ability to sell the company at any price. In terms of value drivers, it's a fairly complex subject, and there's a lot of different factors to look at. We've listed the key ones here. In terms of some of the ones that we spend a fair amount of time with business owners on, desired business metrics, revenue and EBITDA, which are listed here on the page, are obvious, but there are frequently other value drivers that can make a huge difference for a company. For example, in the SaaS software space, areas relating to recurring revenue or customer retention are important. And the most successful companies that we've sold, the management teams have identified the value drivers and they manage them. And that can be critical to really helping think through building the value of the company. Another thing that we spend a lot of time working on is predictability of the business. Buyers want to buy businesses that are stable, solid, and predictable. And there are ways to engineer predictability into a company if it's thought about. So managing the company to budgets, having repeatable systems and processes in place so that you can predict the outcomes, and looking for ways to build in recurring revenue and recurring, more stable revenue opportunities in the business, whether it's through maintenance contracts, long-term contracts, et cetera, can improve the value and predictability of the business. In terms of saleability factors, there are a lot of factors that come up, but effectively it requires stepping back and looking at what the big risks would be and eliminating those risks. The psychology of a buyer, whether it's a private equity firm or a public company, there's an individual at that company that's sponsoring the deal, and that company won't want to, and the individual won't want to take unknown risks. And so really thinking about what are the potential risks in my business and working to get rid of them or engineer them out is important. And so one of the things on this page is compliance with industry regulations and standards. Often smaller companies that operate under the radar screen can get away with some of these risks. We've had issues with clients where they're not following HIPAA rules exactly, or they're not following Telephone Consumer Privacy Act rules or other regulatory standards where they haven't crossed every T and dotted every I. The business runs fine. It's not a risk for the business owner as it is today. However, the buyer looks at it and calculates what potential fines could be if there was an issue, and it creates uncertainty. And so really taking those things seriously is important. The second thing that we spend a lot of time with our clients on is the quality of their financials, in terms of really impressing upon them the importance of having accrual-based GAAP financial statements. Without that, it's very difficult to sell a business. If the financials are not, well organized and well documented, cash basis, et cetera, it makes it difficult to sell a company. So investing the time and money to have accrual-based financial statements is critically important. Again, I'm Channing Hamlet with Objective, and I hope this was helpful.